Hey there, Mad Money viewers! Welcome back to another exciting episode where we break down the latest financial news for you. The Federal Reserve just wrapped up their latest meeting and made a significant decision to keep interest rates unchanged. This decision came as a bit of a surprise to many analysts and investors. A lot of folks were betting on a rate cut, expecting the Fed to ease up on their monetary policy. The economy is still humming along, with consumer spending and business investments showing resilience. So, what gives? The Fed is playing it cautious, weighing the risks and benefits of any policy changes. While inflation has cooled down from its peak, it's still not at the Fed's 2% target, which is their comfort zone. They don't want to declare victory too soon and risk a resurgence of inflation. The job market remains strong, with low unemployment rates, but there are some cracks appearing, such as slowing job growth in certain sectors. This pause in rate changes gives the Fed more time to assess the overall economic situation and make more informed decisions. They can observe how the economy reacts to their previous rate hikes and whether those measures are having the desired effect. Additionally, they can gather more comprehensive data on inflation trends and employment figures to guide their future actions. Bottom line, the Fed is in a wait-and-see mode, carefully monitoring the economic indicators before making any further moves. They're not ready to cut rates just yet, but they're not ruling it out either. Stay tuned for more updates as we continue to follow this developing story. Now let's talk about the economy. It's still in pretty good shape. We're seeing solid growth, low unemployment, and consumer spending is holding up. Jerome Powell, the Fed chair, even said that he doesn't see a recession on the horizon. He thinks the economy can achieve a soft landing. That means bringing inflation down without causing a recession. This economic strength is making it harder for the Fed to justify cutting rates. Lower rates stimulate the economy, but the economy doesn't need much stimulating right now. It's like giving a Red Bull to someone who's already bouncing off the walls. So, the Fed is stuck between a rock and a hard place. They want to support growth, but they also need to control inflation. It's a delicate balancing act. Historically, the stock market loves rate cuts. When the Federal Reserve decides to lower interest rates, it often sends a ripple of excitement through the financial world. When the Fed lowers rates, it makes it cheaper for companies to borrow money. This reduction in borrowing costs can lead to increased investment in business operations, expansion, and innovation. That can lead to higher profits and stock prices. Investors, seeing the potential for greater returns, often flock to the stock market, driving prices even higher. We've seen this pattern play out time and time again. Historical data shows a strong correlation between rate cuts and subsequent stock market rallies. In 2008, the Fed slashed rates to near zero to combat the financial crisis. This drastic measure was aimed at stabilizing the economy and restoring confidence in the financial system. The stock market bottomed out in March 2009 and then went on a massive bull run. This recovery was one of the most significant in history, lasting over a decade. More recently, the Fed cut rates 3 times in 2019. These cuts were preemptive measures to sustain economic growth amid global uncertainties. That helped to extend the bull market that began in 2009. Investors enjoyed a prolonged period of gains, with stock prices reaching new highs. So, there's a clear historical link between rate cuts and stock market performance. This relationship has been observed across different economic cycles and market conditions. But remember, past performance is not indicative of future results. The market is forward-looking. Investors must consider various factors, including economic indicators and geopolitical events. It's already pricing in the possibility of future rate cuts. Market participants are constantly analyzing data and making predictions about the Fed's next moves. If the Fed doesn't deliver, we could see a sell-off. Investor expectations play a crucial role in market dynamics, and any deviation from anticipated actions can lead to volatility. Now let's bring Bitcoin into the mix. Bitcoin is a digital currency that's not controlled by any government or financial institution. It's often seen as a hedge against inflation and economic uncertainty. When the Fed cuts rates, it can weaken the US dollar. That's because lower rates make the dollar less attractive to foreign investors. A weaker dollar can make Bitcoin more appealing. On top of that, we have the 2024 election coming up. Elections are always a time of uncertainty. Bitcoin could benefit from that uncertainty as investors seek safe havens. Remember, Bitcoin is a volatile asset. Its price can swing wildly in both directions. But if the Fed does start cutting rates, it could be a tailwind for Bitcoin. Section 5, Layoffs versus Job Openings, Decoding the Recession Riddle. Understanding the dynamics between layoffs and job openings is crucial in decoding the recession riddle. This delicate balance can provide significant insights into the health of the economy. One of the key indicators the Fed is watching is the labor market. The labor market acts as a barometer for economic stability and growth. Specifically, they're looking at the number of layoffs and job openings. These two metrics can tell us a lot about business sentiment and economic momentum. Layoffs are a sign that companies are starting to get nervous about the economy. When businesses anticipate a downturn, they often reduce their workforce to cut costs. They're cutting costs in anticipation of a slowdown. This preemptive action is a defensive measure to protect the company's financial health. Job openings, on the other hand, are a sign of business confidence. When companies are optimistic about future growth, they expand their workforce. Companies are hiring because they expect the economy to continue growing. This hiring activity reflects their belief in sustained economic expansion. Right now, layoffs are still relatively low. This indicates that businesses are not yet in panic mode, but job openings have been declining. A reduction in job openings suggests that companies are becoming more cautious. That suggests that the labor market is cooling off, but it's not in a deep freeze yet. The gradual decline indicates a slow adjustment rather than a sudden halt. The Fed is hoping to see a soft landing in the labor market. A soft landing would mean a controlled slowdown, avoiding a sharp spike in unemployment. That means a gradual slowdown in hiring without a surge in layoffs. This balance is crucial for maintaining economic stability. If they can achieve that, it would go a long way towards avoiding a recession. A soft landing would help sustain consumer confidence and economic growth, steering clear of a full-blown recession. Section 6, the Fed's crystal ball versus market expectations. The Fed has its own forecasts for economic growth, inflation, and interest rates, but the market also has its own expectations, and sometimes those expectations diverge. Right now, the market is pricing in more rate cuts than the Fed is projecting. That means investors are more optimistic about the economy than the Fed is. This difference in expectations can create volatility in the markets. If the Fed doesn't cut rates as much as the market expects, it could lead to a sell-off. On the other hand, if the Fed is more dovish than expected, it could spark a rally. It's like a game of chicken between the Fed and the market. Who will blink first? Only time will tell. Section 7. Recession Rhetoric. How the Fed's words could move markets. The words that the Fed uses to communicate its message can have a big impact on the markets. For example, if the Fed starts using the word recession more frequently, it could spook investors and send stocks tumbling. On the other hand, if the Fed remains upbeat about the economy and downplays the risks of a recession, it could boost market sentiment. That's why investors hang on every word that Jerome Powell utters. The Fed is trying to strike a delicate balance. They want to be honest about the challenges facing the economy, but they don't want to cause a panic. It's a tough tightrope to walk. Section 8. Bitcoin's potential a safe haven in the storm? If the economy does take a turn for the worse and we do enter a recession, Bitcoin could benefit. That's because Bitcoin is seen as a safe haven asset. In times of economic uncertainty, investors tend to flock to assets that are perceived as being safe and stable. Gold is a classic example of a safe haven asset. Bitcoin is often referred to as digital gold. Of course, there's no guarantee that Bitcoin will go up in a recession. It's still a relatively new asset class, and its price is very volatile. But if investors start to lose faith in traditional markets, Bitcoin could emerge as a winner. Section 9. The Fed's balancing act, inflation, employment, and growth. The Federal Reserve has a dual mandate to maintain price stability and maximum employment. That means they need to keep inflation under control while also promoting a healthy job market. These two goals are often at odds with each other. When the economy is growing quickly, inflation tends to rise. That's because businesses have more pricing power and consumers have more money to spend. To combat inflation, the Fed can raise interest rates, but higher rates can also slow down economic growth and lead to job losses. It's a delicate balancing act. Section 10. What's next for investors navigating uncertainty? The current economic environment is characterized by uncertainty. The Fed is in a wait-and-see mode. Inflation is cooling, but it's still above the Fed's target. The labor market is strong, but there are some cracks appearing. So what should investors do? First, don't panic. Market volatility is normal. Second, stay diversified. Don't put all your eggs in one basket. Third, have a long-term perspective. The market goes up and down in the short term, but over the long term, it tends to go up. Section 11. Stay ahead of the curve. Subscribe for more insights. Want to stay ahead of the curve and get my latest insights on the markets? Then subscribe to my channel. I'll break down the latest economic data, Fed pronouncements, and market trends so you can make informed investment decisions. Don't miss out. Subscribe now and join the Mad Money community.